Everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 a.m. the UAE time, and we have Brent crude up nearly 2% this morning in Asian trade, sort of 74, above $74 a barrel now, 74.25 on Brent, and even WTI is above $70 a Brent. Different reasons being reported today, something indicating that maybe Iran is not done with its reaction to the Israeli strike last weekend. All these sort of rumors moving around. Dr. Rad Al-Qadiri, non-resident fellow, Center for Strategic and International Studies. Your thoughts on that issue? Obviously, we haven't had a chance to talk to you since the Israeli retaliatory strikes on Iran last weekend. Is that still floating in the air? Does this problem not gone away?
No, I don't think the problem has gone away. Whether or not Iran is preparing for retaliation or not, I mean, the indications out of Tehran since Monday have been essentially that they are seeking to de-escalate and sort of recognize some of the challenges moving forwards and some of the dangers moving forwards. And Iran has been relatively contained for the past year in terms of its involvement in this. The report suggests that, Israeli intelligence reports are suggesting that attacks will come out of Iraq. And I think sort of armed groups in Iraq have equally been relatively calm. The government there has sought to contain them and make sure that they act with restraint. So we'll wait and see. But I think in the broader sense, the market might be underpricing the risk rather than overpricing it. Just simply because, this crisis seems like, and this war seems like it's got some way to go. And fundamentally, what's going to determine it is going to be Israeli policy. The Israelis have signaled for the moment at least, that, they're one and done. But there's also I think, some speculation and some concern that, the Israelis will target Iran directly again, waiting to see what happens in the presidential election for that in the US. But ultimately, as long as this war goes on, then the risk in terms of an Iranian-Israeli confrontation, I think, is going to be there, and therefore the risk to markets.
Let's welcome Jorge Montepuk, Managing Director of Benchmarks at the Onyx Capital Group. Jorge, your thoughts on the direction of travel? I mean, we'd kind of, after the dramas of October, it is November 1st today, Dias de los Muertes, to those who are celebrating that day. The idea that this sort of geopolitical crisis and premium had drained out of the markets after the events of last weekend, which were relatively dismissed and based on the fundamentals, we're back into the low 70s. How do you read the supply-demand balance as we go into the final months of this year?
The macros continue very negative with some minor green shoots of improvement in China and in the US, but very, very minor. So if we take everything in the totality, it's still negative. I think industrial production globally is kind of shrinking, and the leader in that shrinkage is Europe, followed by a tepid China, which now is getting help from the central government, and also a tepid Japan and South Korea. So the only really bright side is the US and the global South. But I think those two areas are not enough to counter slow China and a definitely weakening Europe. So from a fundamental point of view, in terms of demand, we are seeing a contraction based on two factors: lower economic activity and a definite bite by the EV industry. That's on the demand side. And on the supply side, you have sufficient oil, and oil that is waiting to be released. So net, we still have room to travel down.
Let's welcome Yan-Chong Niu, Director of Oil Research for Asia at the London Stock Exchange Group. Yan-Chong, your thoughts on, I mean, we have overnight some positive news out of China. China's October factory activity returned to expansion according to the fairly respected Caixin PMI index. Your thoughts on where China's at? It's sort of this constant uncertain outlook, but yet China's still there, still growing at close to 5%.
Well, I mean, China has been sort of, in terms of the macroeconomic numbers, has been a bit of a seesaw, right? Some days, some months the PMI is good, but some months it's not so good. But broadly, right, has it translated into oil demand? I would say no, because I mean, one of the main consumers of oil demand in China is the property sector, right? And there is still almost zero construction activity going on. Right, the latest stimulus that was released by the government, the so-called the most aggressive stimulus since COVID, has an initial impact of lifting property stocks, but that was about it, right? And for China's oil demand to actually come back, it would take a lot more than that. And as of now, you know, we have seen China crude imports, refinery runs have been falling quarter on quarter, right? And the lowest is this quarter, right? The last quarter that's just ended in Q3, right? Q4, but at the same time, the Chinese government has also come in to say that, well, you know, we are going to restock our SPR again, right? They've mandated to take in 60 million barrels for SPR. We guesstimate that they have about 300 to 310 million barrels in SPR right now. So we are also actually seeing, because we actually forecast the vessel flows into China, right? And we see there's a gap between what is going in as vessel flows and what they are reporting by customs as imports. Because whatever goes into SPR is not counted as imports. And that gap has grown from April. The gap is now from April till September is about 4.5%. Prior, it was about 2.5%. So we are seeing more barrels going into SPR, and we are seeing exactly one SPR site taking a lot more oil, right? This particular SPR site is Huizhou. Again, before April, it was averaging about 235,000 tons a month. After April, it's about 445,000 tons a month. In August, it's peaked at 680,000 tons a month. So they are stockpiling, right? Why are they stockpiling? I think, okay, my thing is that basically the Chinese have been trying to take in more crude and produce more diesel to try to stimulate the economy. That was one of the reasons. The other thing was, remember the last time we talked about, we think they're stockpiling, right? But I think it's come to a point where they've done it for 2 years, 2.5 years. It's come to a point where the refiners say, we can't take it anymore. Right? Please let us go back to managing around refining economics, and that's not fantastic. That's why cracks are not great internationally. It's been coming off big time. We are now at sort of $13, $14 a barrel, and domestic gas oil margins are not fantastic either.
Rad, the big, obviously, news, as it has been for some time, and alhamdulillah, that one of the great benefits of the event next week, the election, is that it will, at least from the point of view of the noise of going to come to an end, one hopes nonetheless. But in terms of the US election, Rad, is there any outcome from this election that do you think moves the needle on the general sort of trading range that we've been in? I mean, putting aside this month of the geopolitical crisis face-off between Israel and Iran, and even with that, we were still stuck in the 70s, high 70s versus low 70s, but that's where we've been. Is there anything, do you think, to indicate that the aftermath of the election, that somehow we break out of that range?
I don't think it'll necessarily be the aftermath of the election. You're an optimist to think that we're gonna have some sort of resolution, or at least final resolution next week. I think if this election proves to be as tight as it is that the opinion polls suggest, then this could be quite a contested vote, sort of well into November. A lot depends, obviously, on the election results, but it's shaping up to be an outcome that is likely to be challenged by either side if it is extremely tight. So I think that's going to add a certain amount of uncertainty to the market, because that has macroeconomic implications, but it also has political implications. I think sort of more generally, people will wait, and the market will wait until January, and the end of January inauguration, because that's when some of the policies will begin to bite. I mean, coming back to the Middle East, I do wonder sort of how the Israelis are going to read the election, and particularly if it does look like that Trump has actually won a second term, then whether their sort of calculations in Israel will be that gives them more scope to take action. And in that lame duck period between November and January, if their agenda really is more than simply destroying Hamas, if it is this regional transformation, and Iran ultimately is the target of that, whether they wouldn't take that as an opportunity in that gap period, that 3-month gap period. So I think there are huge political risks that sort of come with that. But on the most part, it will be wait till the end of January and see, but again, particularly if it's a Trump administration, what that's shaping up to be.
Jorge, of course, the big sort of news as well that's the market's kind of waiting for, not quite sure it's priced in fully yet, is what OPEC Plus are going to do next. The current state of play is that come December 1st, OPEC Plus is committed to increasing supplies, although incrementally month by month, but nonetheless a big shift from a bit like the Fed changing course of direction from raising interest rates to lowering interest rates. OPEC Plus is moving from cutting to increasing supplies of oil. Your thoughts on their decision to do that? Should they, will they follow that through? Does the election result have a bearing on it? Your thoughts on OPEC Plus next move?
Well, I had the wonderful opportunity this week of being both in Dubai, Abu Dhabi, and then in Beijing, where I am. So I can give you really fresh impressions of what the people I talk to say. If we back up a little bit, number one, the situation in China does feel soft. I haven't been in Beijing for a number of years, but there is not a great change in terms of economic visible activity. In fact, it's a lot less. No construction, car usage doesn't seem that much higher, and people shopping, apparently they have shifted online. And in the Middle East, I'm also hearing a greater usage of EVs. So it's not just here in China, but it's also in the Middle East, because in the Middle East, the price of electricity is very low and the Chinese have good product. So EV is eating into oil. Alongside that, the OPEC members, particularly in the Gulf, have a lot of bottled in oil that is waiting to come out. As we have said, we're in polite company here, but Iraq, Abu Dhabi, and are still going above what their nameplate capacity is. And in my meetings here in China, when we talk about Abu Dhabi, they'll just politely smile or impolitely laugh about the OPEC limits. So it is widely acknowledged that Abu Dhabi is way over their ceiling. And regarding Saudi Aramco, the big one, the industry here is waiting, well, a few things. Saudi Arabia has signaled to them they will increase production in December. So that's a done deal.
Well, it's more
And
the signal. It's stated policy. It's itemized in granular detail.
Yeah.
Every country, how much they can increase.
Yeah, and we talked to them as well, and they also told us directly that that's their plan. That's their policy, to increase production in December. So it's done. Now, the question is by how much? And I have spoken to the Chinese lifters here, and the Chinese lifters are waiting for their OSPs, for the official selling price. And they say if the Saudis signal by reducing the OSP, then will require more, will nominate greater nominations to increase the lifting. So the two sides still have to meet via the price. But all the indication up to today is that yes, they will meet and more supply will hit the market. So all I can say is good luck to those guys that are 74, 75, because more supply is coming in, demand is soft, and what we have seen up to date in terms of the engagement in the Middle East is a choreographed dance between two people that don't like each other very much at all, but they continue to dance to pretend that they're angry with each other somehow, stepping on each other's toes, but they're not slapping each other in the face. Do they have the capability to slap each other in the face? Well, if the US gives weaponry to Israel, yes. Israel by itself cannot do it. And Iran can do some of it, but it also needs to do it. Do both sides want that? I don't think so. So again, good luck to those who are very low.
In the context of Asia, Yan-Chong, the outcome of the U.S. election, no real change of direction. What Dr. Rad is pointing out until there's actually a change of government in late January. But sentiment-wise, how do you think the outcome from the election could change the economic mood, the geopolitical mood in Asia?
Well, I mean, Trump has already said that he would impose 60% tariffs on China if he becomes president, right? So it's quite clear that, but I mean, whatever it is, whoever becomes president, from a China perspective, is going to be worse, right? It's just how much worse, yeah? And from a China perspective, okay, fine, you impose more tariff on me, my economy is going to take more to improve my economy, right? So increasingly, China would move away from the Western markets, as we have seen, right? I mean, if you look at what the BRICS Plus meeting recently, right? China shook hands with India, as Jorge says, they're still dancing each other, they may not like each other, but they are not slapping each other at this moment, right? So China is looking, well, I mean, China is still a big manufacturing, the world's biggest factory, right? And for the economy to improve, it would have to continue to be, right? And as such, they would have to find alternative markets if it becomes too expensive in the West, right? So I think from the perspective of the rest of Asia, it's probably, I mean, like say from India perspective or from a Southeast Asia perspective, probably I would say the world would, or Asia would prefer Kamala simply because she's going to be less inward looking and less draconian than Trump. Trump would be more draconian, looking at only US interests, and if you don't like it, too bad. Right? So I think that's where we are.
Let's go to the survey question, which is looking at this point of the US election next week. Will the US election result be a game changer for oil markets to move prices into a new trading range out of the 70s? You know, whether that might be bullish or bearish. Yes or no? It's a massive event on so many levels for everybody in the world. And yet, like many other things, these oil markets have been unperturbed by much. The equity markets might be dancing to records every week, gold banging its head off new ceilings every day, and yet oil sits quietly in the corner, wondering when it's going to be invited to the party. Will the US election, even the biggest event of the year, be any event that might move it or shake it out of its slumber? Yes or no? Rad, you mentioned in your earlier comments, I'd like to sort of drill down a little bit into that, maybe the markets are underestimating the geopolitical risk premium that still exists. Could you sort of extrapolate on that? It's been something that it has spiked momentarily in recent years, even obviously most notably in the aftermath of Russia's invasion of Ukraine. We were up to above 130, but very briefly, and it sort of tamed down again. And on these moments of uncertainty in the Middle East, it spiked up a few dollars, but tamed down again. Where do you see the reason or not for a greater risk premium?
I think it just goes back to the Middle East. I mean, what the market has been is a show me mentality. But, all of the reasons that I've discussed earlier, that, fundamentals are relatively sloppy. And as a result, the market is focused on that, and, it wants to see signs of physical disruption before it really reacts. I think that the uptick that you saw prior to Israel's attack on Iran sort of gave you an indication that sort of when this war in the Middle East starts to get closer or potentially closer to oil assets, and particularly potentially closer to the Gulf region, then markets start to see some dangers. But I think it really comes from that. There was, the way that the price fell off this week is sort of suggested that the market believes that it's a one and done or a two and done, depending on how you want to look at it. In terms of Israel and Iran. But I think there is that risk that, again, we're not at the end of this war, and therefore the risk of escalation still stands. You can see the market's reaction to, the rumors that are there after the Israeli intelligence leak about an Iranian retaliation. But what this comes down to is the more this war is Israel-Iran, the closer it gets to oil assets and the higher risk it has for oil flows. And I don't think we're out of the woods yet in terms of this crisis.
I'd like you to just pick up, obviously you mentioning the Middle East per se, but I mean, in some ways, it seems to me that the outcome of the election in the US could have much greater bearing on the Ukraine position and Europe, America's support for Ukraine, and then Europe being sort of compelled to comply with a new vision for Ukraine, and that being a much greater than the Middle East. Your thoughts to taking the Ukraine position? Is there much at stake there vis-a-vis this election result?
There's a huge amount at stake vis-a-vis this election result. I mean, the Trump campaign and Trump himself have sort of made it clear that they have a grand deal and a grand bargain, not necessarily one that Ukraine wants to see, but fundamentally that they want to alter US policy towards Ukraine, both in terms of direct support, financial support, but also sort of more indirect political support as well. So yes, there's a huge amount at risk. And it's the same dynamic as I'm talking about in the Middle East. It is, Trump coming in potentially and giving very different signals about what US policy will be, what the US will accept from antagonists in both conflicts. And fundamentally, that sort of whether the US will seek to put restraints on those antagonists. And so, I think from a Ukraine perspective, that is a really serious point. I mean, the notion that Trump has been sort of, running around with this notion that, there are huge financial flows going from the US to Ukraine on a very regular basis, exaggerating both the figures and the how often it happens. But the underlying point is that what Trump and Vance have both signaled in their statements have been that US policy, US support for Ukraine will change. Its material support, in particular for Ukraine, will change, and it will seek to force a solution, and one that Ukraine probably isn't going to like, almost certainly isn't going to like. So that's a significant shift in US policy.
Jorge, your thoughts on some of those points that Rad brought up, but also, and adding to the, like, where do you see this market getting direction from? And in that, obviously, the earlier point, does OPEC Plus proceed with its increases or not? And has the market already priced that in, given it's been stated policy for some months now?
I think clearly, if Kamala wins, it's a continuation of the same. So a slow or even faster bleed in Ukraine, and a degradation really of ammunition and people in the Middle East, but a slow bleed. If Trump comes in, he has stated super clearly he wants the nonsense to stop, both between Ukraine and Russia and also in the Middle East. He has stated super clearly that he wants some form of peace, maybe not the peace that we would like, but a peace. And at the end of the day, everybody's happy with that. So has this been priced in? I think starts to be priced in because the betting markets are saying that Trump is going to win. Never mind the polls, the sentiment where people are willing to put their money is that Trump is going to win in those betting markets. And the traders, therefore, by nature, bettors, and they're adopting those things. This is why we're not exploring 80 or 80 plus based on some Middle Eastern fight and a mythical closure of the Strait of Hormuz, which is not possible to do anyway. So reasonability is coming in. But I think the direction of the market is to explore lower lows with a big fight to be had to cross the 70 again. In the last few months, it would be the third time we are heading and poking into that direction. So in the next few days, those signals of peace, and also the vice president is also making similar noise. So it's a commitment by the upcoming new administration. Everything is on the table, all the chips are there, the odds are there, and therefore those who don't listen to those odds are at great danger of being caught long while the market resets into the 60s.
Yan Chong, last word with you on that. Anything here that could be coming through the election week that changes the direction of this market? And to what extent has the market priced in all inevitable outcomes?
I think the market, the market is basically focused on the bearish, right? The market is focused on the global economy, Chinese economy, OECD economy, etc. Right? Since October 7 last year, the situation in the Middle East has escalated, right? It's escalated to a point where Israel is hitting Iran and Iran is hitting Israel directly, but yet prices have actually come off since then, right? 3-4 months ago, we were comfortably at 80-85, right? And then suddenly we popped below 80, right? And if I remember that week when it popped below 80, there was no real fundamental reason. I think that was the week where they said there was an agreement for Libyan production to come back. Like that would have such a big impact on the market, right? So we think that the market finally realized that, look, actually it is not as rosy as OPEC would have us believe, right? Demand growth is not 2.25 million barrels a day. And they themselves have revised that forecast 3 times since, right? IEA has reduced that forecast to today is like around 900,000 barrels a day, right? So, and that is the underlying sentiment across the market, right? Of course, if somebody says something, oh, I'm going to hit, Israel says I'm going to hit Iran's oil infrastructure, of course there will be a reaction, as we have seen, right? But that didn't happen, and we are back to where we were, right? I mean, I believe that the markets went up $2-3 today. Some guys are just taking profit at 71, you know, and the same guys will take profit at close to 75. So we are in that ding dong between 71 and 75 for now, until the next trigger changes fundamentals. The US election, probably not immediately, but I think there'll be more of an impact if Trump wins in terms on the price than Kamala, because if Kamala wins, it's same old, right? And if Trump wins, then things are going to change, right? So if he ends the war on however terms that he ends it, then obviously the war risk premium goes away, right? I don't think it's that much to begin with in the first place right now. Yeah, as the punters do not think that.
Well, we'll
this-
have to wrap it up there
Yeah.
with the survey result of this room, at least 60-40, showing no, that the US election will not be a game changer to move out of the somewhat doldrums trading range in the mid 70s, plus or minus a few dollars over many months now. We will wrap it up there for the week. We will be off next week as we're going to be all at ADIPEC, the world's biggest energy event in Abu Dhabi, and we're publishing today the energy markets outlook that we have harvested from our recent Fujairah forum with 30 voices, including the great Jorge and many others. So please share that and take time to engage with it. Rad Al-Qadiri, as always, have a great week. You'll be coming back, I hope, with some great analysis as to how this is all going to play out for us in the outer reaches of the Roman Empire. We spectate and hope for the best. Jorge, thank you so much. As always, safe
Thank you very
travels. Yang Chon Yo, thank you so much. Have a great weekend, everybody. Oil prices up today, 2% so far. We'll see if Europe and America concur with those sentiments when the markets open.